This is the Asia Trade. I'm Shery in Tokyo.
I'm Avril in Singapore. The top stories this hour. Asian stocks set to trade cautiously after a tepid session on Wall Street, with investors holding off on big bets ahead of the Fed decision. President Trump expected to speak soon about the economy as worries about the U.S. job market grow. Also ahead, China's inflation numbers due later could show deflationary pressures easing slightly. Officials signal concerns about global trade as they prepare next year's economic plans. And SpaceX said to be planning an IPO that would seek to raise more than $30 billion, making it the biggest listing of all time.
Take a look at how we're setting up for the Asia market opens. We are seeing Nikkei futures pointing to some upside, with the Japanese yen holding at very close to that 157 level against the U.S. dollar. Of course, we had Governor Ueda's commentary yesterday talking about potentially attaining that 2% inflation target, really giving some indications that we might see that rate hike come next week. And all of this coming at a time when we also are digesting some of the latest South Korean jobless numbers for the month of November. Coming in right now, rising to 2.7%. The estimate was for that 2.6% hold. We are also seeing 225,000 jobs added in the South Korean economy. This, of course, after we saw more job support programs coming from the South Korean government. But right now, also the focus on Australia. The ASX 200 at the staggered open still up about 0.25%. Remember, we had the Aussie dollar spiking. We had bond yields rising to a 13-month high after the RBA held steady. But at the same time, we heard from the governor that the next likely move was a hike rather than a cut. So we'll continue to watch all of the latest developments around, of course, central bank policy, Avril, as we're also headed towards the Fed decision.
That is absolutely front and center. Take a look at how U.S. assets fared overnight. There wasn't much movement or conviction when it came to stocks. You saw the U.S. 10-year yield moving towards the 4.19 level. Even the dollar picked up. But the data, not just coming out of South Korea, also in the U.S., where you saw job openings hitting a 5-month high, and small businesses, the sentiment among them actually improved. And at the same time, we also saw more layoffs. So this underscores the conundrum that the Fed faces at a time when it's not getting a comprehensive picture on the U.S. economy, particularly when it comes to employment. Typically, at a time like this, we would have gotten the October, November data for the jobs market already. Instead, we're getting it next week. And this is going to be after the FOMC, Shery.
Yeah, the U.S. economy in focus as the Fed decision looms. President Trump also set to speak in Pennsylvania to address voters' economic concerns. Let's bring in Bloomberg opinion columnist John Authers and senior editor Derek Wallbank. Let's start with you, Derek, because we are awaiting that speech in Pennsylvania, very much focused on a key concern among Americans, the cost of living.
That's right, Shery. Look, affordability has been the word to watch in political circles ever since the most recent elections, when you saw Democrats do very, very well in New Jersey, New York City, in Virginia and Pennsylvania, some other places like that. And then we even saw in Tennessee just recently, even though Democrats didn't win an off-cycle congressional seat, they split their margin by about half from where they had in 2024 in the presidential election. So you're seeing Democratic outperformance on this issue of affordability. Now, affordability is a little bit different than inflation. It's not necessarily just where prices are, but it's how much do Americans believe that the things that they want, that they sort of see as baseline needs and expected wants, how much do they think those are within the reach of their pocket? So it's income, it's also fixed costs, and it's also those sort of like near fixed kind of things that people really want, like higher education and things of that nature. And all of those together, when you consider the president's tariff policy and some other moves he's made, have turned into a bit of a liability for the president. You should hear him talk directly to that today.
John, let's bring you in. It's all about the FOMC as well. What about the debate that's raging on still about whether this is going to be a dovish or a hawkish Fed cut?
I think it's going to be a hawkish cut. I'd be very surprised if it wasn't, because effectively the mere fact that there will be a number of dissents, a lot of interest in exactly how many, more or less guarantees that any impact from the dovish impact from the cut will be diluted. I don't really think in many ways that this cut matters terribly much. If you look at where Fed funds futures have been for the end of next year, where they think rates are going to be a year from now, we saw a big turnaround in expectations for tomorrow's meeting, accompanied by more or less no move at all in what people were expecting a year hence. People have really moved on to wondering who the next chairman is going to be, and whether they're really going to be able to cut further as the president wants.
And one of the front runners, of course, for the Fed chair is Kevin Hassett. John, take a listen to what he had to say.
If the data suggests that we could do it, then like right now, I think there's plenty of room to do it.
Plenty of room, which plenty is more than 25 points.
Correct.
Okay. We're already seeing the downside when it comes to treasuries. What's the risk when you really think of this idea of a more dovish Fed because their independence is at risk next year?
Yes, and it's part of the reason that if you look at the way the long bonds, the 10-year has been behaving, as it's become clearer that Kevin Hassett is the front runner, it's obvious that the bond market doesn't think this is a good idea, that trying to run the economy too hot will cause the government to come to grief. It's quite hard to find anybody who seriously thinks that rates can get significantly below 3%. The president himself is on record. You never know whether he's talking with his tongue in cheek. Is on the record as saying that he wants it to get down to 1%. I think when it comes, the other critical point, which Kevin Hassett didn't address in that soundbite, but which is obviously very important, is all other things equal. If you're serious about fighting inflation, you do not want to cut rates. But if the broader issue is about affordability and particularly of house prices, then you do. That is a big dilemma for the next 12 months.
Derek, how concerned are Americans about job security at this point?
I think you do see this popping up a fair bit more. I mean, we've had a lot of people sort of concerned that we were in a low hire, low fire kind of environment where it was very difficult to get a job. But it also, people were thinking that what they had, they would probably stick in with. There have been some signs in recent weeks that maybe the back end of that equation is something that people are taking a little bit more seriously now, and that there is a little bit more concern for baseline, will I be able to keep the job? And you're starting to see that show up in a number of different ways. I think a lot of people are talking about this issue of a K-shaped kind of recovery situation where you have at the very top line spending going quite well, but when you get sort of down a level that it's not quite going quite as well, and people having a little bit of caution. I mean, I was seeing this in surveys of how much people thought that they were going to spend for Christmas was maybe a little bit less. At the same time, you do get some contradictory indications. Black Friday was a pretty good event overall in terms of consumer spending in the United States. So you are seeing a little bit of that sort of mixed thing. But certainly I think tying overall this issue of affordability, and this certainly plays into the issue of affordability, that's going to be a huge driver. I also think that there is a certain amount of concern among the electorate about what the AI revolution is going to mean for people and jobs in the short to medium term. You could also see that become an issue that the president will have to be addressing.
And John, globally, we are seeing this downside pressure not only on treasuries because of all of the issues ongoing in the U.S. economy, but just global sovereign debt, especially given that we are seeing more signals of the end of the easing cycle. We heard that for the RBA Governor Michelle Bullock, for example, yesterday, and we are seeing more issuance. Is this just a trend for 2026?
It could well be. We've also got Germany will actually, if all things going well, actually start spending all the money it advertised this year that it wanted to do. Its big fiscal reform. You also have Japan with Takaichi dedicated to trying some stimulus. I think the greatest concern, the greatest issue is here in the States. There is a midterm election. The experience of Trump 1.0 was that there was a big stimulus came online with the tax cut at about this point, at the end of the first year, beginning into the second. Then you had a very big correction in the February of year two of Trump 1.0, and then you had quite a nasty market break, which helped ensure that there was a blue wave in those midterms. One suspects that the administration will be trying very hard indeed to make sure that doesn't happen again, which would likely mean that much more fiscal juice over the next 12 months and a greater risk of something untoward happening thereafter. But
John, thank you so much. Bloomberg opinion columnist John Authors, and we appreciate our senior editor Derek Wallbank, also part of this conversation. Thank you to you both. Coming up on the Asia trade, Credit Agricole tells us why it sees continued divergence in China's economy as we look ahead to November inflation numbers. NFJ Investment Group offers insight on the Fed's policy path, and Futurum Group discusses Microsoft's AI investment pledge in India. Much more ahead. This is Bloomberg. Bloomberg has learned that SpaceX is moving ahead with plans for an IPO next year, and sources say it aims to raise significantly more than $30 billion, with the company seeking a valuation of about $1.5 trillion. Let's bring in Bloomberg Tech co-anchor Ed Ludlow. So, Ed, this could be one of the biggest listings ever. Talk to us about what we know. Why did SpaceX feel that moving ahead next year might be right timing?
Yeah, what we understand from sources is that SpaceX management have told all of the relevant and interested parties this is happening. Mid-2026 is the target. And you're right, the target is to raise significantly more than $30 billion, which, is a moment in history that would make it from the value of the dollar raise perspective, bigger than what Saudi Aramco did in 2019. They raised $29.4 billion. The why is Elon Musk has talked recently about that SpaceX's financial health and not needing cash. But what sources explain to me is that beyond SpaceX's known goals, make humankind a multiplanetary species, develop Starship, they're increasingly looking at the market for space or constellation-based data centers. Satellites that have high-performance GPUs on board, particularly for inference. And that will require a lot of capital for them to muscle into and develop as a nascent market because they'll have to buy the GPUs.
How's your business doing right now?
Healthy. My understanding, and I think Elon Musk has talked about 2025, revenues around 15, 16 billion. Sources tell me the briefing right now from the company is somewhere between 22, 24, 25 billion next year. The majority of it is Starlink. And again, on X, Musk recently disputed that SpaceX was raising money. By the way, we never reported that SpaceX was raising money. We reported there was a tender offer where insiders and employees were able to sell shares. But in that post, Musk explained that the cash flow position of the company is very strong. And that's about Starlink. It's a much higher margin business than the business of launching rockets and payload into orbit.
Ed Ludlow, Bloomberg Tech co-anchor there with that potential IPO coming from SpaceX. Let's talk about Nvidia now, and we're learning more about why President Trump has allowed sales of its H200 chips to China. Let's bring in our Asia Tech correspondent Annabelle Jewelers. Annabelle, what do we know so far?
Yeah, well, actually, I do need to call out Ed on this, Ed Ludlow, because he just led the reporting on this story. But essentially what we're hearing here is more details on why President Trump chose to shift his stance so significantly on Nvidia and its capabilities to sell into mainland China. Because if you remember yesterday, we were talking about some of our analysts at Bloomberg were saying this is the most significant pivot we've seen yet when it comes from the US toward China on its access to advanced technologies. So what we understood, or what we're understanding from sources, is that this is a decision that was very much based on comparative technological advantages, and specifically what the Trump administration was looking at was Nvidia versus Huawei, which of course Huawei is the undisputable chip leader in China today. So the Trump administration is said to have been looking at a platform that's called Cloud Matrix 384, and that is built on the Ascend chip series. And what they found is that it actually performed quite similarly to one from Nvidia that's known as NVL72, that's built on the latest generation Blackwell chips, or Blackwell designed chips. So that obviously sparked a lot of concern because, of course, the US has really been trying to keep its advantage in this technological race. Now there's that concern that China is continuing to catch up. And also what added to the risks, essentially, or the sense of urgency, according to our sources, is that US officials looked at the production capabilities, and what they're looking at for Huawei for next year is that maybe they're actually going to be able to produce a few million of their Ascend chips. We've also been reporting on this at Bloomberg, but the Ascend series is their line of AI chips, and they're able possibly to ramp up production quite significantly in the coming 12 months.
Belle, this change of heart from Trump on the H200s, might it be coming too little too late?
Yeah, well, that's the risk, essentially, and I think you see that really in the advantages that Huawei is ostensibly already making in this race. But we have had some reporting on this, or some reaction from this from our Bloomberg intelligence team, and they're saying, yes, that there's already a preference that's being built in the Chinese market for them to go to homegrown players. And you see that as well, that companies like Baidu, Alibaba, Tencent, they're already continuing to prioritize those domestically built AI accelerated chips over Nvidia's. And part of that concern also comes down to the supply chain robustness, because the Trump administration has very much flip-flopped on the export policies. Buying local, of course, that's also something that the Chinese government wants to see, and is continuing that push into self-sufficiency. So that's part of it. But you've also got this reporting from the FT, and they're looking at essentially whether Beijing would actually grant Chinese companies the capabilities or the power to be able to purchase these H200 chips. And what the FT is saying is that regulators are looking at different ways to limit permits for access to those chips, and that buyers may need to end up going through certain approval processes. So no final decisions, the FT says, just yet, but I do think it's saying the risks that we were very much discussing yesterday around, yes, even if the White House or the US says that China can buy the H200 chips, it doesn't necessarily mean that Chinese companies will actually purchase them.
Belle, thank you so much. Annabelle Drolas for us there. We have more ahead on the Asia trade. This is Bloomberg.
And this is the latest from the corporate front. Microsoft has pledged to invest $17.5 billion over 4 years to help build India's cloud and AI infrastructure. CEO Satya Nadella made the announcement after meeting with Prime Minister Narendra Modi in New Delhi. This marks Microsoft's largest investment ever in Asia, as it targets the world's most populous nation to help fuel growth. Oaktree Capital co-founder Howard Marks says AI has created a terrifying outlook for employment. He warns that the assumed productivity boom from AI fails to consider how many people will be able to afford the additional goods produced. Marks adds that some firms are piling on aggressive debt as big tech spends vast sums in an AI race designed to keep smaller rivals from catching up. Apple's chip chief Jony Xiaojia has told staff he will stay at the iPhone maker for now. This comes after Bloomberg reported that Xiaojia had discussed leaving the company with CEO Tim Cook, suggesting he might join another technology firm. Xiaojia's potential departure would worsen a bout of executive turnover that has recently hit Apple. Sources say Cook has been working aggressively to retain Xiaojia.
Now, HSBC CEO Georges Elhedery is ramping up the integration of generative AI into the lender's operations. Speaking on the New Leaders with Francine Lacroix podcast series, Elhedery discussed the technology's impact on productivity.
We now rolled to 170,000 of our colleagues internal productivity tools that can materially improve their capabilities of reading documents, reading emails, writing documents, emails, querying, challenging,
the dream
process. 170,000 of our employees. I mean, soon all the way to the 200,000+ employees. But for the moment that's in the rollout phase, we've already reached 170,000. Of course, I will be monitoring usage. I'll be monitoring super usage. Those will be the most, kind of influencing among their colleagues to drive the utilization. But utilization is not optional, because that's how people remain very relevant in the future workforce 5 years down the road. But we're using Gen AI in wealth, we're using Gen AI in markets, we're using Gen AI in contact centers, we're using Gen AI, of course, in technology. Now 30,000 of our technologists, engineers are enabled with Gen AI. The speed at which we're able to patch for, say, code weaknesses or kind of vulnerabilities is 10 times faster already now with coding assistance than it was the case last year. 10 times. And we're not talking
in 12 months.
In 12 months. We're not talking some productivity in 5 years. We're talking productivity already here. We're already 10 times faster at identifying and patching some of these vulnerabilities in our code. This is hugely transformational. So you can imagine how important it is. Now I go back to the first part of your question, Francine, is what are the skills that are needed for banks? I would say there is no one particular skill that's going to be critical, but it is going to be the ability to learn. Because you can come in a bank coming from an engineering background, from a technology background, from an accounting background, from a finance and economics background. You can even come into a bank somewhat from a different field than directly related to banking. But once you're in the bank, your career, the customer's expectation are such that you're going to have to continuously learn. And if you think you know it all, then there is no place for those, in an evolving landscape. It's very important to continuously be ready to learn and put in the hours and the effort to learn something new, a new skill, an additional skill. Today, the most important learning capability is how to best embrace Gen AI and innovation in general.
China's top leaders have signaled unease over potential tensions in global commerce as the country faces a worsening economic picture. Investors are now looking ahead to the November CPI and PPI prints due in a few hours. Bloomberg Economics sees deflationary pressures easing slightly but still entrenched. Estimates show consumer prices tracking a little higher and producer prices narrowing their drop marginally. Let's bring in Xiaojia, Chief China Economist at Credit Agricole. Xiaojia, good to see you. So we're watching out for those numbers in 2 hours from now. What are you expecting to see, and how soon can we see deflationary pressures easing off in China?
Yeah, I think the inflation picture could be an ongoing trend of improvement. In this month, I think it's particular that the CPI inflation will likely rise quite significantly by 0.6 percentage point to 0.8% year-on-year in November, from previously 0.2% in the last month. I think if this is confirmed, this will be the fastest expansion of the consumer prices in nearly 3 years. Is a positive signal. Meanwhile, PPI deflation will likely continue. We actually forecast a pretty stable reading compared to last month. We think the reading could remain at about minus 2.1%. So I think the inflation, if we look at last month, we see a notable increase in the food price inflation, especially driven by vegetable and fruit prices. Meanwhile, core CPI inflation could remain quite stable after keep rising in the past 6 months, and we think it could be about 1.2%. So I think the core CPI inflation, the continued mild recovery in core inflation is a positive sign that the previous policy easing had started to show is a gradual driving force in driving higher inflation. That said, if food price inflation that has been supported by like weather disruptions in the last months may not be sustained all of that.
Is that partially why, from the Politburo readout, we, to some, had a bit of disappointment when it came to stimulus? Is this expectation that we're seeing a consumer recovery because of past support for the economy?
I think if you look at the growth so far in 2025, it has held up relatively better than market expectation when we started this year. So consumer prices continue to rise, but it's at a very gradual pace. And if we look at PPI inflation, we think it's going to linger at least until mid of next year. So that picture is better than before, but we are definitely not out of woods yet for the Chinese economy. So if we look at the Politburo statement, I think is overall, I think is still encouraging that it confirmed the still continued policy easing stance. But that said, the Politburo did signal a little bit more confidence in their capabilities of maintaining growth stability, so that they will continue to make the policy easing to stay in place, but they are probably not super urgent for the Chinese policymakers to really to introduce major stimulus at this point.
So without bazooka stimulus, what are the implications for the Chinese government bond markets? Because we saw that spike in 30-year CGB's yields recently.
If we look at the re-steepening of the China's bond curve, yield curve is still very mild if we compare to some of the developed market bond yield trend. Lately, there has been some of the little increase, but it's not very is not very significant. Going into the next year, I think on the long end, we probably still see kind of a range trading, because on one hand, people could be more hopeful of the continued improvement in growth, especially for the nominal part. But on the fiscal part, I think China, if we look at the fiscal policy, is going to be supportive, but not very massive expansion. So in the first half, I think for the long end of the curve, it might ease a little bit compared to now. But in the second half, we probably see some mild increases as nominal GDP growth will likely to expand faster compared to real GDP when the GDP deflator turns positive.
What does all of this mean for the Chinese yuan, which is very close to, again, record highs for the year?
Right. I think into year end, when the Fed is likely to cut in December, according to market expectation, this did have a little bit more support to the other non-dollar currencies, including CNY. And if we look at the seasonality, and if we look at the very significant trade surplus that we have recorded so far this year, I think is bodes well for a continued strengthening of the CNY against the US dollar. But that said, I think PBOC, while it becomes a little bit more less worried about the CNY depreciation pressure and it showed more signal to allow some of the flexibility and the adjustment of the CNY, this adjustment pace is still relatively moderate, and as PBOC may not want a very rapid build-up of the market expectation of a one-way CNY move. So into next year, I think if we look at the CNY, we as a bank, we still think the US dollar strength could be maintained. This is a little bit different from the market consensus. So against this backdrop, we think this CNY, we maintain a constructive view, but we don't think CNY will likely strengthen very massively into next year.
So constructive view on CNY, and then maybe also along with relatively tepid producer prices, how might that help the exports picture for China next year? As we hear, Chinese authorities seem to be more aware or concerned about global commerce into 2026.
I think export of China will likely remain quite resilient. If we look at China's export, it remains very competitive. And if we look at China's manufacturing, it continues to be very strong. And also, if we look at the Politburo policy signals has been sent, China seems to be quite determined, continue to develop this technological-driven growth as well as to continue to strengthen its manufacturing sector. So we think that the export outlook could remain relatively resilient, but of course, the export growth and the contribution to growth from exports may not be as supportive as this year. We think the goods export growth could soften a little bit to 2.5% year-on-year compared to this year about 5%. So that is shows that the export contribution to growth could be about halved into next year. So the Politburo says they still want the top priority for the Chinese economy is to expand its domestic demand to develop new productive forces. So I think they will put a little bit more emphasis on developing domestic demand next year, and I think fiscal policy will be very important.
Xiaojia Ji, always good to have you with us, Chief China Economist at Credit Agricole. And these are some of the other global headlines that we're following. Australia's ban on social media for under-16s takes effect today, with platforms facing hefty fines if they fail to block young users. TikTok, Instagram, Snapchat, YouTube, and Reddit say they will comply despite opposing the rules. Policymakers in countries including Indonesia, Denmark, and Brazil are weighing similar measures, with some proposing parental approval for users under 18. South Korea has scrambled military aircraft after 7 Russian warplanes and 2 Chinese planes entered its air identification zone. Seoul says they flew above waters off the peninsula's eastern and southern coasts, but did not breach territorial airspace. The joint flights add to regional tensions already heightened by allegations that Chinese fighter jets locked fire control radar on Japanese aircraft amid a diplomatic dispute over Taiwan. President Donald Trump says Russia has the upper hand in its war in Ukraine, citing the country's size and strength. Trump has also criticized European leaders for what he calls excessive dialogue that has produced scant results. European leaders have pushed back against his remarks, with some calling for greater independence from the U.S. on security policy. We'll be watching President Trump's comments today at Mount Pocono in Pennsylvania. He will address inflation and the economy at the Mount Airy Casino Resort. Polling consistently showing the public trust in President Trump's economic leadership is faltering. We'll bring you those comments live here on the Asia Trade. This is Bloomberg.
Let's take a look at how Asia currencies are faring. The dollar picking up for a second day amid higher yields. And despite those expectations of a rate hike from the BOJ next week, we're still seeing relative weakness on the yen. Dollar yen pushing towards the 157 handle. For more on the outlook for the dollar, let's bring in our chief Asia FX and rates correspondent, Ruth Carson. So, Ruth, the dollar is in focus. We're waiting for the Fed decision and its signals. How are investors positioning?
Absolutely. It's all about the dollar today. Investors are certainly counting down the hours to the Fed decision. We know that markets are overwhelmingly betting that there will be a cut coming. So we are seeing the dollar as a result trading in a tight range because remember, markets always move ahead of central bank policy decisions. And we're seeing that. We're seeing the Aussie, for example, strengthening against the dollar. And we're seeing probably the exception is the yen, which we know is still under quite a bit of pressure, but definitely all eyes will be on how Powell and the Fed signals policy is going to look like into 2026 for the Fed. And definitely macro traders, FX currency traders will be taking their cues from there as to whether or not they turbocharge buying or even selling the dollar.
And you mentioned the Japanese yen, and really the expectation is that even if we get a rate hike next week, that will really not make a difference for its underperformance, right? But we continue to get guidance from the BOJ that they will move.
Absolutely. And if we look at swaps markets and what swaps traders are signaling, the last time I checked, it was about 88% expectation of a BOJ hike next week. So when you look at it in theory, the yen should certainly be stronger than where it is at the moment. Yet we are looking dollar yen at levels that are around 156. Cheryl, I think you really hit the nail on the head there. People are signaling that perhaps it's just not enough just yet. Deliver the 25, deliver more. Otherwise, we'll continue selling the yen. And it's not just a dollar yen story. It's against the euro and other currencies as well.
What about what we're seeing in JGBs? Because it looks like yields at these levels have been kind of enough to entice investors.
Yeah, absolutely. And it's fascinating to see crunching data that on a monthly basis, and if you look at trading turnover, foreigners now dominate 65% of JGB trading. Now, that's up from 12% in 2009. So a huge difference, and it shows how much activity there is in the JGB market. So investors like Pimco have pointed out that on a hedged basis, JGB yields are actually enticing. There are reasons to go in there to invest and trade. But if you look at a nominal level, sure, it is definitely below the likes of Australia and even the US. But keep watch on this space. There are a lot of pressures, everything from BOJ hikes through to auctions that often can be quite weak on a historical basis, and that would influence JGBs.
Ruth Carson, Bloomberg Chief Asia FX and Rates Correspondent, of course, as we keep an eye on the FX space, not to mention also the commodity space, because we continue to see these gains when it comes to precious metals related stocks. Silver already topping $60 an ounce for the first time ever. It actually nearly doubled this year. We have a historic supply squeeze, but at the same time, expectations of a Fed rate cut, of course, and we have seen gold also continuing to gain ground. We have more ahead on the Asia trade. We'll bring you live comments from President Trump on his economic policy when he delivers his speech in Pennsylvania. This is Bloomberg. We continue to watch Japan's sovereign debt space as the 10-year JGB yield hovers near that 2% level, and we saw lackluster demand when it comes to the 5-year auction that we had yesterday. Of course, we are headed to a potential rate hike coming from the Bank of Japan next week. Governor Ueda already saying that they're getting closer to attaining their inflation target of 2%, but that they need to achieve this on a sustained basis. Governor Ueda there speaking yesterday, commenting on where they are when it comes to price pressures. Of course, we have seen the inflation pressure being increased by the fact that the Japanese yen continues to weaken. We are talking about levels close to 157 against the U.S. dollar. Finance Minister Katayama has already come out saying that the government will take appropriate action to address excessive volatility or disorderly moves in the currency. In the meantime, when it comes to the JGB space, we are seeing more commentary coming from foreign investors that they could potentially offer opportunities. We are getting breaking news when it comes to the Japan PPI numbers, rising 2.7% year on year, coming in line with economists' expectations and at the same level of growth as the previous month. When it comes to the month-on-month number, is also growth of 0.3% as we continue to watch the price pressures on the factory gate side of things for the month of November, Avril.
Yeah, Shery, in the meantime, on to one of the top stories we've been tracking this week in relation to media deals. Money manager Mario Gabelli says it's highly likely he will tender his client's Warner Brothers Discovery shares to Paramount. The longtime media investor says the terms of trade favor Paramount, including an all-cash proposal that doesn't rely on publicly traded stock. Paramount has launched a hostile takeover bid for Warner Brothers just days after the storied Hollywood studio agreed to a deal with Netflix, Shery.
And Avril, Disney also unfazed about possible changes to the Hollywood business landscape. Co-chairman Dana Walden told The Circuit with Emily Chang that Disney is well equipped to handle tougher competition.
I don't worry about a stronger competitor coming out of it because we already went through an incredible transformation in 2019 as Disney integrated the entertainment assets of Fox. We already went through, a big M&A event to expand our library, to increase the amount of IP that we ultimately could take over the top directly to the consumer. So I'm not worried right now. I also think whomever ends up in this situation acquiring WBD or any asset that's available, these are situations that require a lot of time. Time for regulatory approval, time for integration, time to figure out, how to combine apps, a lot of the things that we've already been through.
Disney Entertainment co-chairman Dana Walden on The Circuit with Emily Chang. Catch the full episode this Thursday on Bloomberg Originals and Bloomberg TV. In the meantime, let's take a look at how U.S. Treasury contracts are faring because we did see the U.S. 10-year yield pushing towards the 4.19 level. We are seeing Treasury futures extending those overnight losses as the Asian session gets going, although not by much. You do get the sense that it's all shaping up towards what could be a hawkish cut from the Federal Reserve, and the pricing from the traders betting on the extent of easing we'll see from the Fed next year has gone from almost 3 to closer towards 2 for 2026. Now, with that in mind, we are also seeing how other Asia-Pacific and global central banks are seeming to signal that they are done with easing. It's not just about the RBA with that hawkishness coming on from the governor just a day ago. You think about the signals from ECB's Isabel Schnabel as well. And it looks like that continued pressure on treasuries, on global debt markets could remain, Shery.
Yeah, elevated inflation, concerns about swelling issuance also leading to that pressure that you mentioned in the global debt markets. And take a look at the ASX 200 after, of course, that RBA hold that you mentioned and the more hawkish turn coming from the governor. We're seeing upside of 0.2%. We'll be watching those precious metals related stocks in the Australian session. Of course, those miners, given those record highs that we continue to see in silver and gold. Nikkei futures not doing much after 2 sessions of gains. We have seen more signals coming from BOJ Governor Ueda that they're getting closer to attaining their 2% inflation target. We just had producer price numbers for the month of November coming in line with estimates at growth of 2.7%. U.S. futures not doing much at the moment. They ended little changed in the overnight session. Of course, we are still awaiting as we continue to talk about the Fed's final interest rate decision of 2025 as we continue to see really speculation on who the next next Fed chair will be. President Trump has said that he has a pretty good idea of who he wants for the Fed chair. We will be listening in to his comments live from Pennsylvania today on his economic policy. Of course, Avril, the key concern for Americans right now, the cost of living.
Absolutely. Affordability is a key concern. We're also hearing increasingly concerns about job security among Americans. So how will the U.S. president send that message to his base in terms of his economic policies? Well, wait and watch what he delivers in terms of that as we wait for his speech in Pennsylvania at Mount Pocono. We have the markets open in Seoul and Tokyo coming up next as well as we watch for this upcoming speech. This is Bloomberg.
Welcome to the Asia Trade. We're awaiting President Trump's comments in Pennsylvania where he will address inflation and the economy at a time when more Americans are suffering from higher cost of living price pressures. And this, of course, coming also, Avril, at a crucial week when we're awaiting the Fed's rate decision as well.
Yeah, and the concern about price pressures, inflationary outlook, that to some is what is prompting expectations of a hawkish cut from the Federal Reserve. And against the backdrop of this lack of data because of the 6-week government shutdown, the wisdom is to go slow when you're driving in the fog. So among the considerations as well for the central bank, Shery.
Yeah, when it comes to going slow, of course, you can't compare to what the Bank of Japan is doing, although we are expecting now a rate hike next week. Governor Ueda again signaling a potential move, talking about being close to attaining their 2% inflation target. Take a look at the Nikkei now opening higher by 0.5%, extending those 2 sessions of gains that we saw already. And the Japanese yen holding very close to that 157 level against the U.S. dollar. We're really keeping a close eye on JGB yields as well. You can see the 10-year yield very close to that 2% level as fiscal concerns linger in this economy. We had a lackluster 5-year auction as well. We got the PPI numbers for the month of November coming in line with the estimates in the previous hour at 2.7% year-on-year. Take a look at how the Kospi is also coming online. We had seen some downside pressure for the Korean market, in fact, slumping more than 20% this year already. One of the big losers recently has been SK Hynix after an incredible rally that tripled the stock price. Now SK Hynix potentially considering the possibility of listing shares in New York. The company is reviewing various measures to enhance corporate value according to regulatory filing seen by Bloomberg. You can see the Kospi and the Kosdaq diverging a little bit at the moment as the Korean won now holds at that 1469 level. We had the jobless rate also coming out of South Korea today, rising to 2.7%, Avril.
Yeah, investors also sifting through the U.S. jobs data, including when it comes to jobs openings or JOLTS rising to that 5-month high. But then you put that together with the layoffs we've been seeing, that data also coming through. What does this mean for the Fed? And as we alluded to earlier, the hawkish cut is what markets mostly are expecting. We're seeing there's treasuries continuing to face that pressure, upward pressure. So you're seeing the 10-year yield. Well, despite nudging towards the 419 handle, you're actually seeing a bit of that coming off in the Asian session. And when it comes to stock futures, overnight we didn't see that much conviction. Continues in Asia. Tracking silver prices as well because it popped above $60 an ounce on these expectations of the Fed rate cuts, also the supply in the market there. When it comes to the Fed chair, the front runner, Kevin Hassett, has also been talking about rates. Have a listen.
If the data suggests that we could do it, then like right now, I think there's plenty of room to do it.
Plenty of room, which plenty is more than 25 points.
Correct.
Okay.
Let's bring in Burns McKinney, Senior Portfolio Manager at NFJ Investment Group. Burns, great to have you with us. So we are setting up for an FOMC that is going to be focused more on the path ahead for the central bank at a time where it's probably at its most divided in a long, long time. What do you see as the prospects for risk in 2026?
Well, with respect to the Fed announcements tomorrow, there's really two places to focus on beyond just simply, the fact that the markets have priced in what we'll call a hawkish cut. The first of which is the good news is that the Fed is cutting from a place of strength. They're not reducing interest rates in order to stave off a nearly inevitable recession, but rather simply just trying to bring down what is currently a restrictive policy down to something that's more neutral. And historically speaking, when you've had a central bank cutting interest rates after an extended pause, that's typically been very bullish for both the economy and markets going forward. That said, the other place that investors aren't really talking about as much that they really should focus on would be that the Fed is also expected to put an end to the quantitative tightening that has been in place, the QT policy that's been in place for the last 3 years, which could have even a wider impact with respect to both easing monetary policy, but also broadening market returns. If you look over the last 3 years, there's been a very tight correlation between this quantitative tightening and small cap stocks lagging the market. So this could actually be a catalyst for a rotation into some of the unloved areas of the market.
We are awaiting President Trump's speech any moment now in Pennsylvania, talking about his economic policy. And of course, we'll be watching also any off-cuff comments when it comes to the potential next Fed chair. What do you think about the independence risk of the Federal Reserve going into next year and the potential implications for treasuries? We have seen, of course, steeper yield curves for the last few years already.
That's certainly one of the risks that investors have to price into the market. I think that, once you get to the point that investors are questioning the independence of the central bank, that's going to lead to the expectations of higher inflation going forward. One of the things that's been very fortunate about this inflation cycle has been that near-term inflation has increased substantially, but inflation expectations have remained in check. And so there is the risk that expectations rise, you end up with a self-fulfilling cycle, which would ultimately lead to higher interest rates down the road.
We are hearing from the Fed chair frontrunner Kevin Hassett speaking to Fox News about how there's a lot more room to go when it comes to rate cuts. But to your point about how perhaps easier policy is going to be for small cap stocks, what is that going to mean for specific sectors, including financial related names?
Yeah, that's a great question. I think that, you hit the nail on the head as far as where investors should focus, not necessarily what this means for the broader market, but what are going to be the individual winners and losers. I mentioned that small caps would be poised to benefit, areas that have been out of favor like value stocks. And within value, I think one place to really highlight would be the financial services sector. That's an area where it's been out of favor. It's far and away the cheapest sector out there. You have a space where the banks have been passing the Fed stress test with flying colors. You have the deregulation that the administration is pushing through. Over the last, really ever since the global financial crisis, because of tighter capital requirements, returns on equity for banks have been lower than they were prior to 2008. So we run the possibility of if capital requirements are loosened a little bit, you could have both ROEs for the banks go up, which would likewise lead to an increase in price to book values. But it could also kick off a wave of banking consolidation, which would also lead to a rally in the shares. And specifically, some of the small and mid-cap regional banks would be those most levered to this trade.
And Burns, of course, we have talked about the potential stretch valuations in the artificial intelligence trade. Here across Asia, though, we continue to see the gains on those related stocks. SK Hynix, for example, at the moment rallying in South Korea because of news that it could potentially list in the U.S. Is there more upside for Asian chip-related, tech-related stocks?
there's certainly more upside. I think that for starters, you are seeing some of the areas of Asia that have really been playing catch up, if not taking some leads, specifically in the AI hardware space. So you have upside there. You have upside just simply from the fact that with the U.S. central bankers easing rates, that benefits long duration securities, which would in fact really point you right towards both some of the more emerging market spaces, places like China, and as well as some of the AI darlings over there.
Burns, just picking up on your earlier point about some of the policy tailwinds, are you anticipating in any way more of that in the fiscal form, or when it comes to Trump and his economic policies, might that also be another tailwind for markets?
Absolutely. One of the way we're kind of thinking about the economic outlook going into 2026 is, I'm here in Texas, and so you guys probably don't get quotes from Merle Haggard, the country singer, very often. But he had a song where he says, "If we make it through December, everything's going to be all right." And that's kind of where we're looking at things now, whereby we're seeing a soft patch of economic data right now that owes primarily to the effects of the increases in tariffs and the fact that some of the fiscal stimulus isn't really kicking in until 2026. But in 2026, you do have rate cuts and tax as well as tax refunds.
Right, President Trump appearing in Pennsylvania right now. We're going to try to listen into those comments. But Burns, as we get to the president, tell us a little bit more about your biggest risks and opportunities for 2026.
Probably the biggest risk would be valuation. Now, when I say risk, bear in mind, we have really two rules for investing. One of which is don't fight the Fed, and then the second rule is again don't fight the Fed. We do have a central bank that is in easing mode, and I think that should really, between that and again, we noted you have going into next year, some of the biggest tax refunds that we've seen in years, as well as other factors such as the expensing of capital spending, which should really give a boost to manufacturing. But valuations have gotten rich. U.S. stocks were up 20% in 23, another 20% last year. They're approaching 20% this year, and so a lot of that good news is already priced in. And you're looking at a market that's trading 22 times earnings, which is well above its long-term averages. So, that doesn't necessarily mean it absolutely doesn't mean we'd be sellers, but it does mean that investors might not expect to see the magnitude of returns going forward that we've had over the last 1 or 2 or 3 years.
What is your sense of then the extent in which we'll see returns for next year?
Well, again, noting that we've got PE multiples on equities of north of 22 times earnings. They've only, if you go back over the last several decades, been more expensive than that about 20% of the time. So it's really tough to make a case for multiple expansion from here. So you're probably gonna have to rely on just growing with corporate earnings. But again, I think that the real key to focus on is that investors don't have to buy the stock market. It's a market of stocks. And so there could be some rotations and some broadening of returns to places that have been out of favor. I noted that value stocks have really been waiting a long time for a catalyst. Financials or areas like healthcare would be another one that could stand to benefit.
Burns McKinney there, Senior Portfolio Manager at NFJ Investment Group. Really great to have you with us, setting up for this speech coming from President Trump in Pennsylvania. He will be speaking about inflation and the economy. Let's listen in.
Here yesterday, like at 2 o'clock in the morning or something. Well, I'm worried about them. Would anybody like to give up your place? Let some people come in from the cold. You go out to the cold. I don't think so. I just want to say hello, Pennsylvania, and I'm thrilled to be back in this incredible Commonwealth with so many proud, hardworking American patriots. That's what you are. So am I. I'm a proud hard worker. I'm a proud patriot, but you're a proud patriot. Thank you very much, everybody. It's a great reception. We're on to we're on to expose what happened recently when we took over. You know, it's 10 months, and already we have the largest investment ever made in the history of, not our country, of any country anywhere in the world. Think of that. But let me begin by wishing each and every one of you a very Merry Christmas, Happy New Year, all of that stuff. Remember when I started? In 2015, I made my first speech, and I said, we're going to bring back Christmas. Remember, the radical left wanted to get rid of the word Christmas. I said, I don't think that's going to work out. And we did it, and now everybody's saying Merry Christmas again. But just over 1 year ago today, with your help, we saved America. That's what happened. We saved it. In the most important election victory possibly in the history of our country was going down. We were a country that was being scoffed at, laughed at all over the world. We won all 7. Thank you, Charlie. She said, and you saved us. Who are you? Stand up, please. Who said that? I love her. Only in Pennsylvania can this happen. I know the state. By the way, last election, did we kick ass? We won. That means we won 3 times in a row, as you know. But we won all 7 swing states. We won the Electoral College, 312 to 226. We won, and by the way, the real vote was much more than this, but we wanted to make it too big to rig. We won the popular vote for the first time of any Republican in many decades, and we won 86% of all counties in America, 2,700 to 525. That's good. We did it. Not me, we did it. And now, after just 10 months in office, I'm pleased to report that America is winning again, Pennsylvania is prospering again, and I will not rest until this Commonwealth is wealthier and stronger than ever before. Remember when Biden got up and called you a state? That was not good. He said, it's great to be back in this state. Oh, where are we? Where are we? What state is it? It's Pennsylvania. Oh, okay. Now, we're respected again as a country. We're respected. Since my inauguration, we've created nearly 60,000 new Pennsylvania jobs, including 4,000 Pennsylvania manufacturing jobs that the Democrats gave up on. You're doing better than you've ever done. Under our leadership, more than 40,000 Pennsylvanians have been lifted off of food stamps. 40,000. And working with a great guy, remember David McCormick? He used to go to every rally I had. He knew what was happening. And he's here again, as usual. I can't get rid of this guy. Where is he? He got a little lucky, though. You know, in Butler, a place called Butler, Pennsylvania. I love Butler, Pennsylvania, but it was amazing. And we had a tremendous crowd, like 55, 60,000 people. Then I called David. I said, David, come on up. He was working like hell to get elected. It was a tough race. And very few people could have done what he did. But I said, right at the beginning of the speech, I said, David, come on up. Come on up. I want to. This was before the thing happened. And then I looked up and I said, you know what, David, just stay there. I'll get you later. You're so lucky, David. You're so lucky you don't know. I could have had a little differently shaped ear if it weren't for you. You know, you got very lucky that day. People don't talk about that, but I remember I called him up and I said, just stay there. Because he was walking a little bit slowly. I didn't want to take the time. Oh, boy, that was a good day for you. What a job he did. He's really a great guy. And his wife, Dina, is fantastic. Thank you. Stand up, David. He's a lucky man. Working with Senator David McCormick, we've secured commitments for nearly $100 billion of investments in Pennsylvania. We were up here a few months ago. Some of the greatest energy companies in the world made that. We were doing it on a beautiful day, a little warmer than it is outside today, David. But over $100 billion, and we've saved a great American company. You know, we saved, this little group of people and me, saved a little company called U.S. Steel, and it's hot as a pistol now. And we have the keys to the company. It's always going to be here. It's never moving. They said, what happens if it moves to Japan? I said, you can't move a steel mill to Japan. You can move a headquarters, but the steel mill stays here. That's all that matters. And I will tell you, the company is spending billions and billions of dollars, and there was no second by comparison. Other companies were interested, and they really are. They call me all the time, tell me they're really excited about it. And, you know, they're building a lot of additional plants. It's turning out to be beyond what anyone thought possible, but we had to save U.S. Steel. U.S. Steel was one of the greatest companies, which really, for a long period of time, years ago, the greatest company anywhere in the world. U.S. Steel was, you see it with the big factories that were, 2 years ago. Now it's starting to fill up. The tariffs have filled it up because people are coming here. Other steel companies are coming to Pennsylvania now because of they don't want to spend 100%, 50%, 25% on tariffs. Are all coming in. It's amazing. You know, the word, remember when I said tariff? My favorite word is tariff. True, but then I got a lot of heat from the fake news. Look at all of them back there. I took a lot of heat. I got up early on. I said my favorite is turning out, you know, tariffs are bringing us hundreds of billions of dollars. I just helped our farmers out because they're starting to do really well. But in order to try and negotiate, some countries played a little cute. And we just gave them, right out of a tariff money, cost us nothing, right out of the hundreds of billions that we've taken in, we gave the farmers a little help, $12 billion, and they are so happy. And all they want is a level playing field. And now it's happening, and the tariffs are making them rich. It's going to be, you're going to see what happens over the next 2 years. It's like a miracle is taking place. But we've taken in hundreds of billions of dollars, really trillions. Scott, we have the great Scott Bessent. Scott, stand up. And if you add to that all of the companies that are pouring their money to building plants in Pennsylvania and many other states, auto plants, AI plants, plants of every type, which we would have never had if we didn't put the tariffs on. Did you see where Europe now is saying, I think we got to start doing what Trump is doing. We've got to start putting on tariffs because we're getting our asses kicked. And it's true. But Scott, if you really think about it, it's trillions of dollars, not billions of dollars, right? So it's amazing. It's the smart people understand it. Other people are starting to learn. But the smart people really understand it. 1 year ago under Sleepy Joe Biden, have you heard of him? You know, okay, look, the King of Saudi Arabia told me this. He said, sir, 1 year ago, I was in Saudi Arabia. Somebody complained that I was making a foreign trip. I went to Saudi Arabia, Qatar, and UAE. I brought back $4 trillion. They said, he shouldn't be traveling. He should focus on home. What the hell do you think I'm doing? And 250 Boeing jets. I brought back so much everything. Then they say, he should, you know, the stupid people, they say, he shouldn't be leaving our country. Yeah, let's sit around and twiddle our thumbs. It's, no, it's sort of crazy, right? But 1 year ago, the King of Saudi Arabia said it. He said, sir, 1 year ago, you were a dead country. Dead. They were focusing on China. They were looking for, you know, who's next on line, frankly. And he's a good man. And the Emir of Qatar said it. UAE said it. The big company, the big, smart country said it. We were a dead country 1 year ago. We were dead as a doornail. We were going down the tubes. And now, we're the hottest country anywhere in the world. There's nobody close. Sure. And it's because of the election on November 5th, because that's when it started. You saw what's happening with recruitment in the military. The enrollment is the highest we've ever had. And, you know, right before November 5th, we couldn't get anybody in the military. We couldn't get police. We couldn't get firemen. We couldn't get anybody. And after November 5th, that's when it started. Right now, we have the highest enrollment we've ever had, the greatest recruitment days we've ever had in the military. It's amazing. So it's November 5th, and it's also, again, it's a thing called tariffs. And I told you, I was about to say that, you know, because I love the weave. You know what the weave is? You go here, bing, 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 bing. You always have to get back to the right location. But otherwise, they'll criticize you for straying from the speech. By the way, if I read what's on the teleprompter, you'd all be falling asleep right now. But it's true, 1 year ago, and during periods of time, I'd say my favorite word is the word tariff. I love it more than any other word in the dictionary. And the fake news said, that's terrible. What about God? What about family? What about religion? What about your sons, your daughters? What about how terrible that's? So I moved it back to fifth. I have it to fifth, and now I'm in no trouble with the fake news, you know? They say, what about religion? They always find, so you have to weave a little bit with the punches. You have to go, you know, the boxers, you got to go with the punches. But it's been amazing what's happened. And it's been amazing. It's a transformation of our country. I have the greatest oil man anywhere in the world. I see him sitting right there, Chris Wright. I was going to put him in, Doug Burgum. He's great. He's interior. And I said, Doug, I want you to go to energy. You're really fantastic at energy. Came from North Dakota. Big fracking place. State. Done really a great job. He was a great governor, I would say, right? Really great. And a great person. He's doing a fantastic job. I said, I want you to head up energy, sir. I'd be good, but I'll tell you, there's one man out there in the whole world. There's one man out there who would be better than me. Who is it? A man named Chris Wright. Who the hell is Chris Wright? Give me a break. I never heard of the guy. Well, you never heard. He's the biggest there is. He's the smartest there is. The greatest oil man in the world. Chris Wright. I said, I got to see this guy. And after about 2 minutes, I understood exactly what Doug was saying. So I said, okay, Doug, you'll go to Interior. You work with, because interestingly, Interior owns all the land that has the oil. And he has all the expertise that drills the oil. And I said, you know, we'll do a friendly merger here. This is pretty good. And that's what we did. And we're right now drilling more oil than we've ever done ever before. Prices are way down. We just had 4 states. It was just reported that 4 states had $1.99 a gallon. Right? We're so moving. So I want to introduce Chris Wright. Stand up, Chris. Who would think, you look at him, he's a nice looking guy and all that. Who would think he's rated, I mean, he's the most talented oil guy. He can put his nose in the ground and tell you whether or not there's oil. Other people have to spend billions of dollars on machinery and equipment, and it doesn't work. So I want to thank you. You're doing a great job. And is it true? We are right now, energy overall, not only the oil and gas, we are right now involved in more energy and have more energy in the works by far than we've ever had before. Is that right? Yeah. Not even close. Yeah. And I have no higher priority than making America affordable again. That's what we're going to do. And again, they caused the high prices and we're bringing them down. It's a simple message. If I had one message tonight, you know, this is being covered like all over the world. This is crazy because I haven't made a speech in a little while. You know, when you win, you say, oh, I can now rest. So Susie Trump, do you know Susie Trump? Sometimes referred to as Susie Wiles, Susie Trump. She's the great chief of staff at the They don't use the word chief of staff anymore because of the Indians got extremely upset. But now the Indians actually want their name used, which is true. They never didn't want it used. But the chief of staff, and she's fantastic, she said, we have to start campaigning, sir. I said, I won.
You've been listening to President Trump making a speech in Pennsylvania, what was supposed to be a sort of affordability rally in order to tout his economic policies. He's been talking about how tariffs has actually brought companies into Pennsylvania. He's talked about how U.S. Steel is staying in the state despite being purchased by Nippon Steel. He kept blaming President Joe Biden for the economic situation. But Avril, what was really interesting is that despite the fact that this was really billed as an affordability rally, we haven't until now heard much about bringing prices down. Remember, his sweeping tariffs back in April really led to more price gains. We're talking about inflation tracking annually about 3%, up from around 2% back in April. So we'll continue to listen to his speech as we want to hear more about the economic measures to help Americans with the cost of living.
Certainly, Shery, we heard from the president touting his cabinet picks, including the U.S. Energy Secretary Chris Wright, and how they are drilling more and the extent in which that is bringing on lower energy prices. And as you see among his base, holding up those placards about just that. Bigger paycheck, lower prices. That's certainly something that Americans want to see. But this is, again, to your point about affordability being a key concern. Think about how that really loomed large for the recent elections and how might all this shape the midterms next year. Now, even as we talk about these price pressures, inflation in the U.S., for the likes of China, it's the specter of deflation, and China is set to release November price data later today in the next hour, with consumer inflation expected to see a modest tick up while factory gate prices remain in contraction. Let's bring our China correspondent Min Lo. So, Min, what do we know about the state of the Chinese economy?
Yeah, I would say the forecast is actually pretty positive if you consider that CPI is expected to come in at 0.7%. Now, this is far below the target of around 2%, but considering the trend so far, that would be the highest print since early 2024 if the actual print meets the expectation. PPI, though, expected to be marginally better, still declining by about 2%, and that really cements the more than 3 years trend in decline in the factory gate prices, and the divergence of the CPI and PPI really shows you how challenging it has been, right? And it also ties into the trade data that we got earlier this week, with exports doing really well but imports lagging behind, and that weak PPI number has been one of the factors that keep China's exports competitive. And you think about, tying this to the U.S. inflation number as well. China's deflationary streak on the factory gate probably is also exporting that deflationary pressure overseas and, saving the U.S. from the worst of inflation and opening the gates for the Fed to potentially cut rates in December. So you got to see, how the Chinese prices is also tying into global prices as well. And if you look at this chart, you can see so far the November data have been overall pretty disappointing, but the CPI, if it really improves, that will be quite a good sign.
So what are we expecting Chinese policymakers to do next year?
Well, we are awaiting the readout from the Central Economic Work Conference, which is expected to happen sometime later this week. But so far, if you look through the Politburo readout that we got earlier this week, it shows that, analysts are expecting that the Chinese government will probably just put in very incremental stimulus policies to boost domestic consumption. It seems like the urgency is still in boosting that high-quality productive forces and leaning heavily on advanced manufacturing to build that moat around Chinese exports. And I think that has been what is disappointing to many investors, but we'll wait for more details. But meantime, another thing to note from the Politburo readout is that the Chinese government talked about taking note of the international trade battle, and it seems like, that vigilance is going to be key for policy making, even as the government had appeared quite reluctant to put out very bold stimulus measures so far.
Our China correspondent Min Lo there. Right, Microsoft has pledged to invest $17.5 billion over 4 years to help build India's cloud and AI infrastructure. CEO Satya Nadella made the announcement after meeting with Prime Minister Narendra Modi in New Delhi. This marks Microsoft's largest investment ever in Asia as it targets the world's most populous nation to help fuel growth. Let's bring in Futurum Group CEO Daniel Newman. Daniel, how important is India for these tech giants? We have seen a handful of them trying to court the likes of Ambani and their empire.
Yeah, this is a really big market. And for Microsoft in particular, it's a really significant opportunity. It's only about 1% of Microsoft's revenue right now, but it's growing at about twice the pace of Microsoft overall. But that's not the only reason. India has been such a hotbed for talent. And in the AI era, we know that the proliferation and the diffusion of these talent, skills, and capabilities to drive their AI ambitions, especially with Copilot, with what they're trying to do with Azure, expanding on zones, bringing capabilities to help build. So many India systems integrators help support US and other large market companies with their development of AI. So Satya has always had a soft spot for India, but it's not, it's not out of just charity. He genuinely sees this as a massive market, and he's making the big bet on that particular market for that reason.
Is it also to offset some of the challenges that these companies face in China?
Of course. I mean, every company right now has to look and say, where is the next biggest opportunity? We saw the last few days, a lot of news about Nvidia. We've heard what Nvidia's dealt with Jensen, with the H200s. He finally gets the market open, then it's not open. The one thing to be sure about China policy for United States tech companies is to be unsure, to be uncertain. And so for Satya Nadella, the relationship between the US and India is very strong. And while there's still some uncertainty related to the trade deals, he knows that the business he has, the investment there, the build out of an India sovereign cloud is something that, that Microsoft is so well suited to make that investment, to expand Azure. And of course, like all the other things I said, to make sure that the talent is being developed in that market. We know we're going to have a shortage of talent. India, China, other parts of Asia have been a big supporter of the expansion of technology across the United States over the last multiple decades. And this is only going to proliferate and accelerate in the AI era.
Daniel, when it comes to how some of these U.S. firms are thinking about investments and these pledges into the U.S., what about the relations between the U.S. and India? Do you think that they put that as part of their calculus and considerations for the risks in such moves?
Of course they do. Every investment that the technology companies are making, whether those are the Middle East investments that have been made, whether that's developing specialized technology to serve China and specific export controls, or moving and investing in the India market. But remember, India is so populous, it's well educated. This supports the need for developers that are going to be able to build in collaboration with AI. The market is really well set up. It's probably outside of China in terms of a combination of population, in terms of growth, in terms of investment, and desire for the particular STEM skills that are required to bring these technologies, not just to India, not just to the United States, but really around the world. It's been such a great collaborative partner. So companies like Google, companies like Microsoft, they genuinely understand Apple. They understand the value of building deeper moats inside of India and how important that's going to be for the long-term growth of their respective businesses.
Talk to us about the potential for some of the growth in Indian tech, given how these big U.S. firms are coming in with more funds. How might that grow out the ecosystem as well?
Yeah, I mean, Avril, what we're seeing is there tends to be a bit of a first act and multi-follow with these types of tech investments. We saw a big wave over the past year or so with sovereign clouds going into the Middle East. Of course, we've seen the same with companies having to figure out how to build diversification strategies away from China. And kind of what we're seeing now is that these big tech companies see a really significant opportunity to expand their business. As I mentioned, Microsoft is literally growing twice as fast from a revenue standpoint. It's also very profitable, and the India companies and the India market is consuming cloud technologies at about twice the rate, or it's at a very high rate, let me say, compared to certain other markets. So this is very good for the Azure business. Microsoft wants to show that its Copilot business is growing, that its Azure business is growing. These are the core tenets of its success. I imagine Google, Amazon, all these companies that I'm mentioning are all going to look at this market as one of the next big opportunities to compete and to bring their products to. And so Satya Nadella is a leader here. He understands this. This isn't the first investment he's made, but you're definitely seeing him, doubling down his plans, his investment, and his desire to grow in that market.
Daniel, before we let you go, the H200 chips being allowed back into China by President Trump. Does that make sense given the security risks and that Huawei already has something comparable anyways?
Yeah, so we've always believed that this is where it would end up. We believe that the U.S. would allow China to buy what would be 1 to 2 generation old Nvidia chips. We also believe that that China wants Nvidia chips. The idea that Huawei has parity to Nvidia, we don't believe that's true from a infrastructure, from the chip standpoint. We do believe from a research, developer, and capabilities, China has certainly done a great job and is very close to parity with the United States. But Nvidia is the chip and the system and the tools that the Chinese developers want to work with. Having said that, there's a lot of political back and forth going on. Now that the U.S. is considering or looking to let this happen, you see China still showing signals that they're going to resist it. We believe that this is more of a negotiation. We believe if China is going to truly keep up and be able to maximize all that talent that it has, it will want to use Nvidia. And even if it does get there with Huawei, and we have seen a lot of progress with Huawei, we believe they're going to want to augment it with Nvidia and AMD and other chips as well. So we see this as a constant political back and forth, but in the end, we think 1 to 2 generations old will land, and we think that China does want Nvidia, but it's not going to necessarily come out and beg for it at this point because it has made a lot of progress.
Daniel, interesting take. Thank you very much for your insights. Daniel Newman is CEO at Futurum Group. Now, as the AI trade faces some investor scrutiny, one stock is shining as an anti-AI play, and that's Apple. Its shares were battered earlier this year on concerns about its lack of an AI strategy. But now that hesitance has gone from weakness to a strength, Apple was the worst performer among the Mag 7s in the first half, but since then, it's soared 35%, while AI hyperscalers have slid into the red. Oaktree Capital co-founder Howard Marks says AI has created a terrifying outlook for employment. He warns that the assumed productivity boom from AI fails to consider how many people will be able to afford the additional goods produced. Marks adds that some firms are piling on aggressive debt as big tech spends vast sums in an AI race designed to keep smaller rivals from catching up. Shery?
And another story that we're following, JP Morgan shares dropped after it flagged $105 billion in expected spending next year. That guidance is higher than the top estimate from analysts surveyed by Bloomberg. JP Morgan's consumer and community bank head Marianne Lake says the anticipated cost growth is due to volume and growth-related expenses, as well as inflation. Wells Fargo's Mike Mayo says JP Morgan's higher than expected expense outlook is a negative for the broader industry. He notes in isolation, others may need to spend more for share as effects roll downhill. He says another industry takeaway is that this is the most competitive environment since before the global financial crisis. Major investors in First Brands have offloaded stakes in the bankrupt auto supplier's debt in recent days. This caused the value of its most senior loan to collapse, prompting the firm to pull forward a lender call to calm nerves. Sources say Marathon Asset Management and Redwood Capital Management are those who sold chunks of the super senior loan they provided to First Brands. KKR's co-chief executive officer Scott Nuttall sees more defaults cropping up in private credit. Nuttall says that defaults are likely to be higher among direct loans backing 2021 vintage private equity and tech deals. However, he also believes people are overreacting to the prospect of higher levels.
Staying on debt concerns, Chinese property developer Vanke is set to meet bondholders Wednesday to discuss a proposal to delay payment on a 2 billion yuan bond due December 15th. For more, Bloomberg's China credit reporter Trista Xinyiluo joins us now. So, Trista, we are seeing Vanke making another push. How does this one differ from the previous iterations?
So bondholders are set to meet at 10 a.m. Local time today to try to review those proposals. And right now they have 3 proposals to consider to vote for. The original one, the first one is the Vanke's original plan, trying to call for a 12-month, delay without paying any upfront cash or any installments. And the other 2 are offering more generous terms, asking Vanke to pay some interest and also offer some credit enhancement. So these are 3 proposals those creditors will review for, and they will have until Friday to vote for.
What's the schedule right now of maturing bonds for Vanke, and what will be the pressures going into 2026?
Yeah, so the bonds they are discussing for the extension today is actually originally gonna due on December 15th. So that's the closest one we are watching right now. And Vanke also already asked for a delay for another yuan bond, which is set to mature in late December. By the end of next June, Vanke will have more than 13 billion yuan note coming to due. So the recent discussion is actually key for Vanke to try to relieve the immediate, payment pressure. And there are already a lot of discussions going on between the developer, local government, and creditors. Even over the weekend, there's a meeting held in Beijing. And right now, we really need to wait and see what's the results coming from the meeting today and what's the final supporting level Vanke can get from creditor.
Trista, thank you so much, as always, for getting us up to speed on this distressed developer. Bloomberg China credit reporter Trista Xinyiluo. We have more ahead on the Asia trade. This is Bloomberg.
We're seeing gains for Japanese equities for a 3rd consecutive session. We're at that 50,000 level, and the Japanese yen holding very close to that 157 level against the US dollar as well. Continuing to see weakness despite the fact that we are almost fully priced in when it comes to that potential rate hike coming from the Bank of Japan next week. And we continue to get indications also from Governor Ueda himself that's saying that they're getting closer to attaining their inflation target, Avril.
Shery, let's dive deeper into the Japanese bond markets. That 5-year auction yesterday drew lackluster demand. And as you alluded to, we have some investor caution on these expectations of a BOJ rate hike next week. Our chief correspondent for Asia FX and Rates, Ruth Carson, is here. So, Ruth, where do we go from here on JGBs?
Yeah, it's a fascinating market to cover every single day, and traders are definitely having a field day as well. If it's not the auction that's influencing, trading, it's obviously the bets on the BOJ's hike. And look, when it comes to yield, how long is a piece of string in terms of how high things could go? Now, what's very interesting, though, is that Pimco, for instance, actually said yesterday that on a hedged basis, JGB yields are actually attractive. And when you crunch the numbers, it's absolutely true. You're looking at over 5%, for example, yields compared to treasuries, which are, around the 4 mark, etc. So is there opportunity to trade JGBs, buy JGBs even at these levels? Yes, the market is signaling so. But is it a buy and hold trade? Now, that's something that is to be debated. And we see that in the numbers. Foreigners now dominate over 60% of trading of JGBs compared to about 12% in 2009.
What are we seeing in terms of yen positioning? Because the weakness seems to continue despite the fact that we're expecting a rate hike.
Yeah, Shery, it's very much a conundrum, isn't it, for investors out there. There are so many yen bulls that I speak with, at the start of the year, and it's hard. It's hard. Dollar yen is at 157 at a time when, swap traders are indicating an 88% chance of a BOJ hike next week. Now, this is, head-scratching stuff. But what are markets signaling to us? Macro traders are saying BOJ, hike. Hike soon and hike fast. Otherwise, the yen will continue to be penalized because rate differentials still matter. Inflation has been above the central bank's 2% target now for years. You're lagging. Start hiking and maybe we'll buy the yen.
Ruth Carson, chief correspondent for Asia FX and rates there. As we continue to follow the Japanese stock market, because we're seeing 3 sessions of gains, but it's really been booming this past year. Still interesting, individual investors sort of having a hard time joining the rally due to some exchange rules. That's prompted some companies to announce stock splits at the fastest pace since 2018. Let's bring in our Japanese equities reporter, Aya Wagatsuma. Aya, tell us a little bit about how retail investors are falling behind.
Hi, great. Thank you so much for having me. And a lot of retail investors, they really want to buy into the Japanese stocks at the moment. But the topics is going record after record to record highs, and a lot of the companies have been going to record highs as well. So just to give you an example, Advantest Corp, so it's a pure AI semiconductor play company, and it's a very hot stock. But if you actually want to get into and buy into the stock, you would need to have around 2 million yen. And that's because in order to buy Japanese stocks, you need to have around 100 lots. That's the minimum in order to be able to buy Japanese stocks. While in the US and the UK, it's only, you can buy it for 1 share. So that's a huge difference.
Which is why we're seeing these stock splits to make it more accessible. Tell us a little bit more about this trend, and is there more to it?
So yes, there is. So a lot of the Tokyo Stock Exchange has been asking the companies to be able to make sure that their shares are at a right price. And at the moment, it's currently going very high at the moment. And for the Tokyo Stock Exchange, they wanted to make it more accessible for individual investors to be able to buy into it. And because the shares have been going up so much, SoftBank Group has actually announced in November that they will be doing a share split due to the fact that their shares have been going up so much because of the AI play.
Do they actually help boost investment?
So this actually does help boost investment, and especially for individual investor shareholding in the companies. So, for example, Suzuki Motor actually saw an increase of about 53% from 2023 to 2024 year-on-year individual shareholder investment due to the fact that they did conduct the stock splits.
Given this trend, are we expecting more of the same in 2026?
Yes, as we go into 2026 as well, a lot of the researchers have said that they will continue to see this kind of share stock split going forward due to the fact that shares have been going up so much. And also another reason is because there has been a lot of activist investor activity in Japan as well. And having individual investors holding on to the company's shares are actually very stable for the company itself, as a lot of them have been silent shareholders. And a lot of it's kind of like a defense for the companies.
Yeah, it'll be another exciting year for Japan. Aya Wagatsuma, Japanese equities reporter here. We do have more ahead. This is Bloomberg. Australia's ban on social media for under-16s takes effect today, with platforms facing hefty fines if they fail to block young users. TikTok, Instagram, Snapchat, YouTube, and Reddit say they will comply despite opposing the rules. Policymakers in countries including Indonesia, Denmark, and Brazil are weighing similar measures, with some proposing parental approval for users under 18.
Shery, let's take a look as well at how those futures fared for Chinese stocks. As we see this week, Hang Seng coming under pressure. Maybe the Politburo readout also disappointed some in terms of stimulus. We are watching out for the price index, the indicators coming out from the Chinese economy in the next hour, and it's expected to show deflationary pressures easing off a little. In the meantime, maybe geopolitics also at play. Trump talking about China buying a lot of their soybeans. In general, this is a market that seems to be lacking in catalysts as we count down as well to the FOMC. That's it from the Asia Trade. Our markets coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai, and Shenzhen. This is Bloomberg.